What if I told you that you could start building passive income today, without a degree, without a big audience, and without waiting for the perfect time? No followers, no fancy credentials? Perfect. You're exactly who this episode is for. Today, we're diving deep into the real practical ways normal people, students, freelancers, creatives, are creating their first streams of passive income. No Wall Street jargon, no influencer hype, just real strategies you can start using right now. So if you've been dreaming of more freedom, more flexibility, and more income without having to show your face online or get another diploma, this is your moment. Let's get started.
Welcome back to the deep dive. We're all about maximizing your knowledge with minimal time wasted. No one wants to walk away feeling more confused than when they started, right?
Yeah, exactly. And today we're going to tackle something that I think a lot of people are really curious about, but also maybe a little intimidated by. That's building passive income specifically through investing.
Okay, so making your money work for you instead of the other way around, everyone's after that, right?
For sure. And we've been digging into this awesome series on passive income. A ton of real stories in there, practical tips. I mean, it's packed.
It is. So our mission today is to kind of distill all that down for you, pull out those key insights, those actionable steps you can actually take to get started with passive investing.
Right.
We're all about making this digestible and useful.
Yeah, and one of the core ideas that came up right away, it's something we really need to clear up, is that investing is not the same thing as speculating.
Okay, hold on, because I think this is where people get tripped up, right? You see those headlines about, making a fortune overnight, and you think that's just how investing works. But the series we listened to made a really clear distinction.
Yeah, it's a big difference. They actually compared speculating to, like, trying to guess what song's going to be trending next week.
Yeah.
You might get lucky once, but it's not a sustainable long-term strategy.
It's not. And they kept coming back to this analogy of planting a money tree, right? You make those consistent contributions, you kind of water it, but you don't keep digging it up to see if it's growing yet. You just let it do its thing.
That patience is huge. And one of the stories from the audio really brought that home. It was Leemie. She started out dabbling in cryptocurrency, and her portfolio, she actually called it a meme museum at one point.
Oh, no.
Yeah, she rode that wave for a bit, but then, market took a dip and she lost a good chunk of her investment.
Yeah, that's the downside of that high risk, high reward approach, but it sounds like she learned from that experience.
She completely shifted gears, started investing a small amount consistently, like $25 a week, into ETFs using an app called Public Meeple. No more checking it every 5 minutes, no more panic selling. She called it her Future Freedom Fund.
Love that name. And it seems like that switch from constantly trying to time the market to just trusting the process made a huge difference for her mentally, too.
Oh, absolutely. The series made a great point about that speculating is all about adrenaline investing, is more about peace of mind.
Yeah.
It's about creating that steady system that's going to work for you in the long run.
Right. So once you have that mindset shift, and again, let's talk tools, because the idea of needing to become some kind of Wall Street guru is definitely intimidating.
It is, and that's what's so cool about what we learn there. There are these straightforward, accessible tools out there. You don't need to be a stock-picking whiz to get started.
So give us the rundown. What are these tools that make passive investing so much less scary?
Okay, so first up, we've got exchange-traded funds, or ETFs. They're like bundle deals for your money. Instead of buying individual stocks, you're buying into a fund that holds a whole bunch of them. It's instant diversification.
Okay, so less risk because you're not betting on one single company to do well.
Right, and they gave some really good examples, VO and SPY. These are ETFs that track the S&P 500. So you're basically investing in the overall performance of the U.S. economy. Those big-name companies like Apple, Amazon, Google, they're all in there.
Okay, that makes sense. And it sounds like these ETFs are pretty easy to buy, too.
Yeah, super easy, especially through apps like Public. Remember Lena? That's what she uses. She puts in $20 a month. She even jokingly calls it her anti-capitalist retirement plan, which I kind of love.
I love it. Then there were index funds. What were those all about?
They're kind of like ETFs, but a little more low-key. They also track market indexes, but you usually buy them directly through brokerages like Fidelity or Vanguard.
Gotcha. And the benefit of index funds?
Often even lower fees than ETFs. And they're designed to be super hands-off. Even Ramit Sethi, in his book, I Will Teach You to Be Rich, he's a huge proponent of index funds.
Okay, that's a big endorsement. Then we had dividend stocks, which sound like a pretty straightforward way to generate some passive income.
It's buying shares of companies that regularly pay out a portion of their profits to shareholders. Think Coca-Cola, Procter and Gamble, even Apple. They all do this.
So it's like getting a little bonus just for owning a piece of the company.
Exactly. And there was this funny anecdote in the series about someone who was using their dividend payments as their boba fund enough to buy bubble tea every month.
Okay, that's awesome. I like that goal. So we've got the tools now. How about those actionable tips for getting started? Because I think that's what people really need to hear.
Yeah, for sure. So they emphasize the importance of user-friendly apps like Public, Robinhood, Fidelity. They all offer fractional shares, which is huge.
Huge. So,
Well, it means you don't need to have hundreds of dollars to buy a whole share of an ETF.
yeah,
You can start with $5, $10, buy a little slice of it, so much more accessible.
that's great, especially for people who are just dipping their toes in the investing world.
Exactly. And they also said pick one ETF that tracks a major index like the S&P 500. Keep it simple for now, and you've got instant diversification right off the bat.
Love it. What else?
Set up automatic investments.
Automate.
Automate. I mean, it takes the emotion out of it, takes the effort out of it.
Right. You're not tempted to try and time the market. You're just consistently putting money in.
Exactly. And they reminded, the market goes up, it goes down, but historically the long-term trend has been upwards.
So patience is key. And the sooner you start, the more time you have for that growth to really compound. Which brings us to the next big concept, compound growth. They called it the eighth wonder of the world.
It really is amazing. They gave this example. Imagine investing $100 a month with an average 8% annual growth. After 10 years, you'd have around $18,000, even though you only put in $12,000, that extra $6,000. That's all from compound growth.
And it gets even crazier over longer periods, right?
Absolutely same, $100 a month, but over 20 years, you're looking at around $55,000 with only $24,000 actually invested. That's the power of letting your money work for you over time.
So it's not just earning returns on your initial investment, it's your earnings generating even more earnings.
Exactly. It's like a snowball rolling downhill, getting bigger and bigger.
I love how they illustrated this with Eli. He was investing in a dividend ETF during his internship, and after just 3 years, the gains alone were worth more than all the money he put in during that first year.
And he said he barely even noticed it was happening because it was all automated. That's the beauty of
It's
them.
like magic, but it's not magic. It's math and strategy. Okay, so speaking of automation, they talked about this hack, the hack for lazy geniuses. I'm all about lazy genius hacks.
This one's all about leveraging automation. It's that setting in most investing apps like Public, Robinhood, Fidelity. It's called automatic reinvestment, or DRP, dividend reinvestment plan.
Okay, what does that actually do?
So whenever you get dividends or even small earnings from your investments, instead of that money just sitting there, it automatically gets used to buy more of the same assets.
Oh, that's smart. So your profits are immediately put back to work, generating even more profit.
Exactly. It's set it and forget it. And it really reinforces that idea of time in the market beats timing the market.
You're consistently buying more no matter what the market's doing that day, that week.
And they snuck in a really valuable bonus tip here about taxes specifically for U.S. investors.
Okay. Tax is not always the most fun to talk about, but definitely important.
For sure. So they explained that when you sell an investment and make a profit, that's called a capital gain, but the amount of tax you pay on that gain depends on how long you held the investment.
So there's a difference between short-term and long-term gains.
Huge difference if you sell within a year of buying it. That short-term capital gain taxed at your regular income tax rate could be as high as 37%.
Okay, that's a big chunk.
But if you hold on to it for longer than a year, it becomes a long-term capital gain. And the tax rates are way lower, 0%, 15%, or 20%, depending on your income level.
So not only are you benefiting from compound growth by being patient, you're also potentially saving a ton on taxes.
Exactly. They gave this example. Say you're the $1,000 investment grows to $1,200. That $200 profit might only be taxed at 15% if you hold it for over a year. Way better than getting hit with that higher rate if you sell it too soon.
And they said a lot of investing apps actually show you how long you've held each asset, which is super helpful.
It is. And they gave this funny little tip about marking your buy date as a reminder to hold on for that lower tax rate hold until date equals low tax group. Kind of get you.
Right. I like it. A good way to stay disciplined. Okay, so we've covered stocks, ETFs, but the series also talked about real estate investing, but not in the traditional way.
Yeah, not everyone's ready to become a landlord or has the money for a down payment on a property. But there are ways to get exposure to the real estate market without all that hassle.
So how do you do that?
Okay, first option is real estate investment trusts. REITs, they're companies that own or finance different kinds of income-producing real estate apartment buildings, office towers, shopping malls, you name it.
So when you buy shares of a REIT, it's like investing in a portfolio of property.
Exactly. And the cool thing is, REITs are legally required to pay out most of their profits as dividends. So you're getting a pretty consistent income stream.
Without dealing with tenants or leaky faucets.
Exactly. And they mentioned realty income, ticker symbol O. They even call it the monthly dividend company because it pays out every month. And you can buy into these REITs through those same apps. Public M1, Finance, Robinhood, often with pretty small amounts to start.
That's interesting. What was the other method they talked about?
Real estate crowdfunding. This is where you pool your money with other investors to fund real estate projects.
Yeah.
You do it through online platforms like Fundrise Arrived Homes, Really Google.
So you're basically part of a group investment in properties.
Right. And these platforms often have really low minimums, sometimes as low as $10 or $100. And you benefit from both the rental income and any appreciation in the property's value, but again, without the headaches of actually owning and managing it.
Right. It's totally hands-off. There was that story about the guy who put $50 into Fundrise and then completely forgot about it. A year later, he checked and had made a little profit.
Totally. And that's the appeal. Both REITs and crowdfunding give you access to real estate's potential for growth and diversification, but without needing a ton of money up front or dealing with any of the landlord stuff.
And they suggested combining REITs with those dividend-paying ETFs we talked about to aim for a more regular monthly income stream. I like that strategy.
That's a good one. Now, we can't talk about passive income without at least mentioning cryptocurrency. It came up in the series, but with a big dose of caution.
Yeah, crypto can be a bit of a wild ride.
That's putting it mildly. So they specifically talk about staking, which is basically locking up some of your crypto on a platform to earn rewards, kind of like earning interest.
Okay. Sounds simple enough. What's the catch?
The catch is crypto is volatile, like super volatile. They compared it to a roller coaster and pointed to those big crashes we saw with Luna and Celsius. People lost a lot of money.
Yeah, that was rough. So what did they recommend for people who are still curious about crypto staking but want to do it as safely as possible?
They said stick to the major established cryptocurrencies like Ethereum or Solana. They tend to be more stable relatively and only use reputable staking platforms, Coinbase, Kraken, Lido, those kinds of names.
And probably the most important piece of advice.
Only invest what you can afford to lose. Treat it like experimental money. Don't go all in on some hyped up coin you saw on Twitter.
Solid advice. FOMO is not your friend when it comes to investing.
Definitely not. They told us a story about Eli. He was staking Ethereum on Coinbase. And yeah, he was earning these small weekly rewards, but then the price of Ethereum dropped and it wiped out all his gains. Yeah, so he learned his lesson, and now he sees crypto as just a small part of his overall portfolio, not the main event.
They had that great analogy about crypto being like dessert. It's fun to have a little, but don't make it your whole meal.
Perfect analogy. Build that solid foundation with those ETFs, REITs, dividend stocks first, then maybe add a little crypto sprinkle on top.
If you feel comfortable with the risk. Okay, so we've tackled some big misconceptions about investing. What's another one that holds people back?
I think a lot of people assume you need a ton of money to get started, which is just not true anymore.
That was a big myth they busted in this series, right?
Huge myth they were adamant about, that so many beginner-friendly apps out there let you start with literally $1.
$1, seriously.
Seriously. Robinhood, no account, minimums, public. They've got those learning resources built in Fidelity. They offer fractional shares, acorns. It invests your spare change for you. The barriers to entry have never been lower.
That's amazing, and I think it makes it a lot less intimidating to take that first step.
It does. And then they talked about the power of recurring investments, setting up those small automatic transfers weekly on payday. Whatever works for you, it adds up so fast.
They had that example of Maya putting $10 a week into an S&P 500 ETF, and after a year she had over $500 without even really noticing the money leaving her account.
That's the beauty of automation, and consistency trumps everything else. You don't need to be perfect. Just get started and let that money work for you.
The earlier the better, right?
Always the earlier the better.
Yeah.
Now, shifting gears a bit, they also talked about the importance of investing responsibly, thinking beyond just returns.
Okay, so making sure your money aligns with your values.
Exactly. They highlighted 3 key aspects. First, diversification. Don't put all your eggs in one basket, even if that basket seems super shiny and promising.
Spread the risk around.
Right. They said a good mix is ETFs that track those broad markets. Some bonds, maybe a little cash for stability.
Got it. What was the second aspect?
Long-term perspective, market dips, crashes,
Yeah.
they're going to happen. It's normal, zoom out, focus on that 10, 20-year horizon. That's where real wealth gets built.
They quoted Morgan Housel on that The highest form of wealth is the ability to wake up and say, I can do whatever I want today. That's the goal.
That's the dream. And long-term investing is a huge part of getting there.
Okay. And the third aspect of responsible investing.
Value-aligned investing, making conscious choices about where your money goes, supporting companies and causes that resonate with you.
So if you care about the environment or social justice, you can actually invest in companies that are making a positive impact in those areas.
There are ETFs for everything these days. They mentioned ICLN for clean energy, ESGV for companies with strong ESG ratings,
Yeah.
SAE for companies with female leadership, ARKW for disruptive tech. You can find something that aligns with your values.
They told a cool story about Eli building a portfolio focused on green energy tech and ESG and how much pride he felt in knowing where his money was going.
Yeah, it's a powerful feeling. And they had a great tip. Use the search function in those investing apps. Type in keywords like climate or diversity. You'll be surprised what you find.
That's great advice.
Yeah.
So we've covered a lot of ground, but to bring it all together, they offered some simple portfolio examples for beginners.
Yeah, 3 different approaches, all using ETFs. They actually mentioned there's a worksheet available with all the details, but we can walk through them here.
Yeah, let's do it. What was the first one?
The conservative portfolio, slow and steady wins the race kind of approach.
Okay, so low risk.
Yeah, the goal is to preserve your capital, beat inflation, sleep well at night.
Sounds good. What's the breakdown?
60% VTI, which is the total U.S. stock market, 20% FD, V&D U.S. total bond market, and 20% VX U.S. for international stocks. Simple, diversified, built for stability.
Makes sense. What about portfolio number 2?
That's the balanced portfolio, steady growth, moderate risk. A good option for folks in their 20s or 30s who are playing the long game.
What does that allocation look like?
40% VOO S&P 500, 30% VX US International, 20% VNQ US Real Estate through REITs, and 10% BND bonds. A little bit of everything.
Nice. And the third portfolio example?
That's the growth-focused one, higher risk, higher potential reward for investors who are younger and comfortable with a little more volatility.
Okay, so what are we putting our money into here?
50% QQQ, that's heavy on tech stocks, 35% VTI, total U.S. market, and 15% RKK, which focuses on disruptive innovation. It's a portfolio designed for those who believe in the power of innovation and technology to drive growth.
Okay, so 3 solid options to get people thinking about how to build their own portfolios.
Exactly. And remember, it's not about picking the perfect one right away. It's about getting started, learning, adjusting along the way.
It's a journey, not a destination, this whole passive income thing.
That's a good way to put it.
Well, I think we've covered a ton of valuable information today. Big thanks to that awesome audio series we were able to pull from.
Yeah, it's been a great deep dive.
The biggest takeaway for me is you don't need to be a financial expert. You don't need a huge income to start building wealth.
Just need to take that first step, even if it's with a small amount of money. The key is consistency.
Right. And remember that every dollar you invest is working for you, contributing to your future freedom.
That's the ultimate goal.
Absolutely. And if you're looking for more info about those portfolio examples or anything else we talked about today, be sure to check out the original audio series. We'll try to provide some links in the show notes as well.
Yeah, great idea. And if you enjoyed this deep dive, do us a favor, share it with someone who might be on the fence about investing. You never know. You might just inspire them to take that first step.
That's a great point. And as we wrap up, I want to leave you with this thought. You don't need to be perfect. You just need to begin.
So true.
And with that in mind, here's one final question for you to ponder. Which of those portfolio examples resonated most with you and why? And what further research might you want to do on those specific ETFs to feel confident and ready to take action? Thanks for joining us on the Deep Dive. See you next time.
See you then.
Thank you for listening. If this episode resonated with you, the best way to support the podcast is to hit like, subscribe to the channel, and share it with someone who needs to hear it. Every bit of support helps us keep creating content that actually matters. See you in the next one.